David, it's good to have you with us. You've been a columnist for Forbes before I was born, 1979.
Yes, I've been a columnist here for a long time and really very much enjoyed it.
And you have a new book out called Contrarian Investment Strategies, but here's the kicker, The Psychological Edge. Just out, fresh.
Yeah.
And so first of all, before we get to your methods of investing and your insights, you say this is the best time, you've never seen stocks as cheap as they are today since 1982. Explain. This
Yes.
is good news.
Well, the averages are way down. I think back in 2000, the S&P was somewhere around 28 times earnings, and normally it's probably about 17 or 18. And now I think on 2012 earnings, it's around 14, 15. So it's very cheap, and companies are strong. Cash flow is good. Finances are probably the best they've been in years, and people are just terrified to go near stocks at this point. These huge outflows to mutual fund, out of mutual funds. I guess they're $200, $300 billion last year alone. I just have made people just want to be out of the market because of the huge volatility and the belief that this depression-like environment will go on for forever.
Talking about earnings, do you see any threat to earnings in 2012, 2013 from overseas? I mean, Europe's going in a recession. Singapore had a bad fourth quarter. We're moving, but not nearly what we should after a severe downturn. Do you think earnings could have a nasty surprise that could upset your scenario, or do you believe that even if earnings take a nick, they're still so cheap, these companies, that they're still worth buying?
Well, I think there could be. It's hard to fine-tune earnings, and they could take somewhat of a nick because of European operations, but the stocks are still very, very cheap, and I don't think it would be a huge nick. Germany's holding up reasonably well, and we weren't hurt much by what happened abroad this year. I don't think we're going to see foreign trade collapse like it did after 1929. I think there might be some changes, but I don't think they'll be very major.
Go through for us your criteria for investing. Of course, PE ratios, sales to profits and the like, and then get into some of the new tools you reveal in this new book.
Right. Thank you, Steve. Well, we've always been contrarian investors, so we bought.
Is that another word for value, or do you feel that? Explain the difference between contrarian and value.
Well, contrarian is a form of value investor where we tend to buy the lowest PE stocks, or by PE ratio, or we can also use price to book or price to cash flow, or even high yields. And there have been studies that go back now as far as the 1930s, and they show that low PE and low price to book have outperformed the market in every decade since I think starting with the 1940s. So it does work. These stocks tend to be, there are a lot of very good stocks that tend to be, people just don't like them, for one reason or another, and they won't pay much for them. And I guess classic examples were the food companies 20 years ago, or I guess the tobacco companies in the 90s, and you get a whole industry, oil and gas, that were very, very out of favor for many, many years, but really had solid growth, strong fundamentals, strong finances, and really excellent cash flow and high yields. So that's basically the type of stocks we buy. We always have a diversified portfolio, because probably 50 to 60 stocks, because we'll miss something. Everybody's going to miss some. I think Warren Buffett said if you can pick 60%, you're doing very, very well, and I think that's very true. And so we have diversification, and we don't take really big bets on any one stock. We try to keep the size of each purchase pretty much the same. And if we buy a company, we'll a new company, a new name, we'll sell another one. And then when we always sell at the market multiple. We buy below market multiple, but when a stock moves up to the market multiple, we'll sell it. Or if there's very bad news, which occasionally happens, we sell immediately. But overall, the strategy has worked well. Unfortunately, it doesn't work all the time. It's going to have its bad years, and then some very good ones. But
so what new metrics, new measures do you have in the book
that
help you find these contrarian equities?
A couple that we're always there, and we hadn't used. I guess the most important would be the fact that if a company has a loss, even if we think it's a short-term loss, we'll sell it and buy it when the company comes back to profitability. That would have saved a lot of us in the financial crisis, because everybody thought those losses would have been very, very short-term, but they weren't. So that's probably important. Diversification is more important than it's ever been, because we're actually putting our portfolios up to, as I say, 50, 60 stocks, and we've actually put together a low PE index fund, if you will, which is primarily, it's all low PE stocks, but we will have 100 and they're equally weighted, and that's done reasonably well over time.
Now, this index, is it just big cap, small cap, a mix?
Well,
how do you put the mix? And it's done just numerically, so if a stock doubles, it's still the same weight as another stock. You don't do it by capitalization or market value.
We have a slew of very low PE funds and clients. We have small cap, mid cap, what they call SMID, which is small and mid put together, and large cap. So those are probably our four big ones. And it turns out over time that small cap, low PE small cap has really outperformed everything around. But if you go long enough, but there will be periods that could go up to 5 years or 8 years. Where
small cap, by your definition, is what?
Well, the definition has probably changed very dramatically since 2008. Small cap was $2 billion in say 2008. I think it's probably I think around a billion, $1.5 billion, probably about $1 billion, $1.4 or $1.5 billion right now. And large cap has come down from 20 billion to probably 10, because the market has really gone down pretty significantly.
Among the new measures you say is if you have a loss, just cut it,
right?
Terms of profit. And what other ones do you like?
Well, I guess some of them are fairly new. They're psychological. There's some new psychology out there that really explains this bubbles and crashes. It's called affect. And what they found in the research, and this is the psychological research, is the more we like something, the more we're willing to pay. And they found that people can pay as much as 100 times what a stock is worth, which explains, of course, the internet bubble and probably all bubbles. We get so caught up in ideas that we even the professionals, that we tend not to look at the real value, which of a stock, and
so
this
we
happens.
fall in love.
Repeatedly, and we never seem to, as a group, learn that.
Well, before we get into the what do you call cognitive psychology,
yeah.
What were the lessons you learned from 2008? You know, the banks took a huge hit. What did you come out with that to sharpen your contrarian philosophy, so that if something goes wrong, it doesn't have quite the devastating impact that it did, even though it may be only short term? The
rule of just not, if there's a loss, don't buy it, is very, very important. But I think we with financial stocks, they're more difficult than most others to really evaluate, because one, you don't get good information even when you talk to senior people at the banks. It may not be deceived. They may not know themselves, because I think some of the very major banks had no idea of how much they owned in subprime.
Right.
And there's a lot of complexities that just don't show you in a balance sheet. You just can't get to. And so I would probably never go as heavily as we had gone into financial stocks. I guess banks would be the most complex, because they're the reporting, although legal by certainly accepted by the SEC, doesn't really go into enough detail to ferret out what really is going on. For example, take a bank like Citigroup. They didn't really have a real handle on their losses at all, I think, even near the top. And I think the same was probably true with some of the big investment bankers, certainly Lehman Brothers and Bear Stearns before them, and I mean the leverage was just enormous. I think normally banks, before they changed the glass, they got around Glass-Steagall, leverage might have been, say, 10, 12 to 1. Well, for some of the banks, it got up to 30 to 1, and for the hedge funds, it got up to 35, 40 to 1. So with that kind of leverage, in really pretty poor subprime mortgages, a 2% drop wipes out, a 2.5% drop would wipe out all the capital, and of course the houses didn't go down 2.5%; they went down 34%. So it's so
even today, you wouldn't buy a Citi or a Bank of America, or just fewer shares?
Probably fewer shares, and also I think today I'd buy the banks that the government has almost put their stamp of approval on, like
Wells Fargo.
Wells Fargo, yes, Wells Fargo and Morgan Stanley. Fleet's another one that came up with stronger than most U.S. bank core stocks of that ilk, and so we'd probably have smaller positions, but we'd certainly look at them here.
Well, that gets to what some of the companies and industries you like. Before we get to oil and gas, which you seem to like, what are some of the other companies you've written in the past about? Allstate, United Technologies. What are some of the favorites on your list?
Well, United Technologies is a conglomerate. If they still they don't use that word, it's a multi-divisional company, but it's been very profitable over a very long period of time. Otis Elevator, jet engines, and I think they're moving into other areas, and I think they've shown earnings growth of 10, 12% a year. Even through the bad times, they still had up earnings. And the bad times being the last few years. So that PE is fairly modest on that. Is down at 14 times earnings or something like that. And so that's the kind of stock we like. We also have a belief that a few years out, when employment starts, even if it's gradual, we'll get down to 7.5%, possibly 7% unemployment. And the Fed we've printed $7 trillion since we've doubled the debt since 2008, and there's a lot of money floating out there, not only in the United States but elsewhere. And we think that we're going to probably face some inflation at most 4 or 5 years out.